Ever wanted to invest? There are so many different ways to invest, and it could become tricky on which route to take. Hello and welcome to our channel. Today we are going to discuss the different types of investments. Investing can seem like the hardest thing in the world. It is always advertised in the media, but never fully broken down to its simplest form. Index investing. An index fund is a type of mutual fund that tracks returns of a market index. Here are just a few examples of market indexes that index funds seek to track. The S&P 500 Index, the Russell 2000 Index, and the Wilshire 5000 Total Market Index. These are types of securities, derivatives, and financial instruments that measure the performance of a specific market or investment strategy. Most experts agree that index funds are very good investments for long-term investors. They are a low-cost option for obtaining a well-diversified portfolio that passively tracks an index. Diversity is a very good thing because it increases the expected return of the portfolio while minimizing the overall risk. For example, investing your money in a company such as Tesla, Apple, Amazon, and Walmart all at the same time would be considered diversity. It's a low risk because your money is in different places, so if one of the companies were to go bankrupt, you would still have your investments in the other companies, you would not lose all of your money. Value investing. It's an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. For example, if a stock is worth $100 and you buy it for $66, you'll make a profit of $34 simply by waiting for the stock's price to rise to the $100 true value. On top of that, the company might grow and become more valuable, giving you a chance to make even more money. Although this is a genius strategy, also used by the famous Warren Buffett, it does have its downsides. The waiting period could be in years. One needs strong belief to stay invested in value stocks. When investing in value stocks, there are certain principles to live by, in order to be successful in that market. Love the business you buy into, invest in companies that you understand, find well-managed companies, ignore the market 99% of the time, and buy businesses, not stocks. Meaning do not worry about how much it is worth in the meantime, it has potential to become more valuable. Income investing. It involves building a portfolio using dividend-paying stocks, bonds, real estate, and other assets that generate cash on a recurring basis. The sole objective of the income investing strategy is to generate a constant stream of income. For example, if you purchase a property, such as an apartment complex, or a franchise from a well-known company, such as McDonald's, you can earn monthly income for as long as you need. Income investing is a very lucrative market. Another example of income investing is annuities. Annuities are contracts sold by insurance companies that make regular payments to you for a set period or for life. You invest an initial sum, then the money is repaid to you in periodic installments, a process known as annuitization. The payment typically consists of both principal and interest. Growth investing. It is a stock buying strategy that looks for companies that are expected to grow at an above-average rate compared to their industry or the broader market. Growth investors tend to favor smaller, younger companies poised to expand and increase profitability potential in the future. Growth stocks are best for investors saving for long-term goals, such as retirement, with a high risk tolerance. They're generally not best for investors close to retirement age or those that need to generate income. Some examples of growth companies are Google, Tesla, and Amazon because they continue to focus on investing in innovative technologies, sales growth, and expansion into new businesses. Active investing. This means investing in funds whose portfolio managers select investments based on an independent assessment of their worth, meaning, the goal of active managers is to beat the market or outperform certain standard benchmarks, essentially, trying to choose the most attractive investments. However, an active investment strategy also has certain limitations such as being more expensive, Actively buying and selling a stock or mutual fund asset adds transaction fees, making active investing costlier, even a higher tax bill. Active managers have to pay high taxes for the net gains yearly. This approach would be the least recommended investment. Passive investing. Passive investing's goal is to build wealth gradually. Also known as a buy and hold strategy, passive investing means buying a security to own it long term. Unlike active traders, passive investors do not seek to profit from short-term price fluctuations or market timing. Slow and steady always wins the race. Passive managers generally believe it is difficult to outthink the market, so they try to match market or sector performance. Maintaining a well-diversified portfolio is important to successful investing, and passive investing through indexing is an excellent way to achieve diversification. The downside to passive investing is the lack of flexibility. Index fund managers usually are prohibited from using defensive measures such as reducing a position in shares. Even if the manager thinks share prices will decline, they rarely beat the return on the index, and usually return slightly less due to fund operating costs. And lastly, defensive investments. Defensive investing typically involves holding a diversified portfolio of asset classes such as lower-risk cash and bonds, plus equities, along with assets whose performance is typically less correlated to stock market movements. Some examples of defensive investments are things such as water, gas, and electric utilities because people need them during all phases of the business cycle. Shares of major pharmaceutical companies and medical device makers have historically been considered defensive stocks. After all, there will always be sick people in need of care. Apartment real estate investment trusts are also deemed defensive, as people always need shelter. There are loads of investments out there. These are just a few that you should look into. But remember, you should always self-educate before making such a decision as investing. Helping people provide a solid foundation for a more secure financial future. One video at a time. We appreciate you tuning in and hope to see you again soon. We hope you learned something from this video. Do not forget to subscribe to our channel and do hit the bell icon on your way out. If you want to learn more on personal finance, click on one of our other videos. See you all next time on Top 5 Hive.